I think when you're in an era of uncertainty like we're in right now, we're in a high era of uncertainty. Everything is uncertain, and not just in the U.S., around the world. And so people are like, uncertain. I think I'll buy some gold. I think I'll own a little gold in here. And I don't. While you may have a setback, and you could if you get up 3,000. So it sells off $150, but I think the next thing will be 3,500. And you have to look at gold that way. If you're going to own it, and don't try to trade the bullion too much. And you can trade the miners, but the bullion, whatever you have in bullion, I think you have to keep it.
Just a day after reaching a fresh record high above $2,950 per ounce, gold is experiencing intense selling pressure. On Tuesday, gold and silver prices sharply declined due to heavy profit-taking and week-long liquidation by short-term futures traders following gold's recent rally. While no serious technical damage has occurred, analysts caution that bulls must stabilize the market soon to prevent further downside momentum. Despite the recent pullback, industry experts emphasize the importance of holding physical gold for the long term. TedOakley of Oxbow Advisors advises against frequent trading, noting that gold prices can remain stagnant for years before making significant moves. He suggests that a temporary dip from $3,000 to $2,850 should not alarm investors, as gold is still poised to reach $3,500 shortly. Looking ahead, some analysts believe gold could climb even higher. While accurately predicting price movements remains challenging, strong indicators suggest that the precious metal could reach $5,000 per ounce. Investor positioning, however, remains mixed. According to the latest data, gold speculators reduced their net long positions by 13,605 contracts to 201,962 in the week ending February 18th. On the other hand, institutional interest in gold remains strong. Holdings in the SPDR Gold Trust, the world's largest gold-backed exchange-traded fund, surged to 904.38 metric tons on Friday, the highest level since August 2023. This reflects continued confidence in gold as a hedge against market volatility despite short-term fluctuations. Oakley also highlights a common trend among investors, taking profits too soon out of fear of a pullback that may never materialize. He points out that mining stocks remain significantly undervalued compared to 2011, even after recent gains, and demand for gold continues to rise amid global uncertainty. While short-term volatility may shake out weaker hands, long-term fundamentals remain intact, reinforcing gold's role as a crucial asset in economic and geopolitical uncertainty. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
I think people are nervous just because they've got a pretty good profit. Sometimes people look at it and say, gosh, I've made X amount of dollars, so it has to come back. Well, it doesn't have to. It doesn't have to come back a lot necessarily. And that happens when you get in a move in an industry group. We see that particularly in the miners. If you look at the miners relative to where they were in 2011, we're not even close on price to cash flow. We're not even remotely close. And it's the smallest part of the S&P. I mean, it's a tiny part of the S&P 500 are the miners. But on gold itself, I think when you're in an era of uncertainty like we're in right now, we're in a high era of uncertainty. Everything is uncertain, and not just in the U.S., around the world. And so people are like, uncertain. I think I'll buy some gold. I think I'll own a little gold in here. And I don't. While you may have a setback, and you could if you get up 3,000. So it sells off $150. But I think the next thing will be 3,500. And you have to look at gold that way. If you're going to own it, and don't try to trade the bullion too much. And you can trade the miners, but the bullion, whatever you have in bullion, I think you have to keep it, because historically, there's been periods when it was flat, down a little bit for 2 or 3 or 4 years, 5 years, and you just had to keep it, because eventually it catches up. And I think the uncertainty right now, though, has not people just in the U.S., but people all over the world and countries, especially, they won't have anything to do with the U.S., and they're saying, hey, we're going to buy some gold. Well, right now, Kai, you have to look at it about how trading, the institutions have just started biting on the miners, just started biting. So they're going to have to go for the biggies. They're going to have to go for Agnico, Newmont, Barrick. They're going to have to go for the stocks that have the volume. They can't go down on the junior end. And we're not a junior miner investor, but I would think, and I still think this will happen, that a lot of those juniors are going to get taken out on the buy side, on M&A, because they can buy them cheaper than they can go mine it. And I could see that happening for the juniors. Again, we don't follow that group, and I'm not the person to ask at all. I think the biggies haven't moved enough yet. That's my point. If you look at where the momentum is in the market, it's in the big. That's where the institutions go to. Individuals will trade them back and forth. I understand that, and they'll trade the GDX, GDXJ, that sort of thing. But I think people that understand the juniors are, my hat's off to them, because it's a tough area to know. But I'm sure there's good money to be made there. It's just not an area we are in.
The U.S. housing market faces challenges, with new and existing home sales under pressure. TedOakley notes that the new home market isn't as strong as widely believed. As public home builders struggle, their stock prices have fallen 10 to 12% after earnings reports and are down 30% since October 1st. Rising inventory levels are forcing builders to lower prices, cutting into profits. Meanwhile, existing home sales in 2024 hit their lowest level in nearly 30 years, despite record-high home prices. According to the National Association of Realtors, sales declined to 4.06 million annually, the lowest since 1995. At the same time, the median home price surged to an all-time high of $407,500. Rising mortgage rates and weak homebuyer sentiment are adding further pressure. Alice Zheng, an economist at Citigroup, noted that with mortgage rates near 7%, a sustained recovery in existing home sales is unlikely in the near term. However, there were some signs of improvement in late 2024, as existing home sales rose 2.2% from November to a seasonally adjusted annual rate of 4.24 million in December. Year over year, sales showed a 9.3% increase from December 2023, when they stood at an annual rate of 3.88 million. While some buyers are returning to the market, the combination of high prices, rising inventory, and elevated mortgage rates suggests that the housing sector may remain under pressure in the months ahead. Let's get back to the interview.
Well, I don't think it would spiral out of control, but we said all along that the next 10 years will be periods where you'll deflate, inflate, deflate, inflate. You've got to learn how to trade these markets. And really, since basically 39% of the people in my industry are less than 40 years old, they don't know how to trade that market. You're going to have periods of deflation, and they're going to think, hey, we're back again to owning long paper and everything will be fine, only to get killed when you reinflate again. And I think that's the biggest problem nowadays. People probably won't know how to do that. And you're going to have, you look at the next 10 years, we said that all along, that you'll have to know sort of when to hold them and when to fold them. Nationally, and I just got these numbers this week, last week, at the end of the week. Nationally, if you look at new homes, now forget about existing homes. Everybody's been saying the new home market is great, it's great, it's great. Well, go look at the public companies. They're killing them. I mean, they'll announce earnings. Some of them have the last few weeks. They're down 10, 12% the next day. And they're all going down. I mean, they're all down 30% from where they were October 1st. And so what's happening is that their inventory is going up too now, the new home inventory. So if you can't sell new homes, which are cheap, $250, $300 a lot of times, and you can't sell existing homes, then all of a sudden the next thing becomes, I've got to lower the price. And when you lower the price, you cut the profit. And that's where I think we are right now. Well, what you have to watch what's happening with services. In other words, if the markets stall, which they have, by the way, the markets are not any higher than they were October 1st. So we've gone 3 months in a row with no increase in the market price. If the next thing is a decline in the market, then that 10% that we've been talking about, they'll cut it back because they won't feel as good, especially if you get 20 or 30 or 40% down. Then they're like, oh, I thought I was rich, but I'm not, And a lot of those same people are concentrated in these big 10 stocks of the S&P, and they're the ones that will get hurt the worst because that's what everybody owns. It's like anytime you look at any market high and you get a break, it's always in what everybody owns the most of. And so that's where they're concentrated, and they're more concentrated today, actually, than I've ever seen, even more than 99 in these 10 stocks. And so what happens is you're going to see that start to take place in PMI services, which I think will really decline quite a bit because people will just say, I'm going to do that. I'm not going to buy that. I'm not going to go on that trip. And they're spending money now like they used to say, like a drunk sailor. But the main point is they got it in the stock market, and you have to watch those two together right now because that'll change things. Ours is that, you need to be careful here. First of all, we screen a lot of companies, and so we know which ones are expensive and which ones aren't. But there's probably 200 200, 250 companies we would like to own out of 3,800, 3,900. But even out of those stocks, a lot of those are expensive. In other words, everything's at the upper end of the boundary. We can't forecast. I'll just tell you, I couldn't forecast anything. However, we can do this. We can tell you when things are extremely overvalued relative to what it should be. And if you look at price to sales of the market, price to market cap, we're even higher on price to market cap we were back in 99, 2000. And people are just basically, they're just whistling down the road, not thinking about it. They're very complacent right now. But some of them are starting to worry. I will say that some of them are starting to worry.
Gold's recent pullback serves as a reminder of the market's cyclical nature, but its long-term trajectory remains compelling. With strong institutional interest and increasing demand, short-term fluctuations may present opportunities rather than cause for concern. Meanwhile, the housing market struggles highlight the broader economic uncertainties investors are navigating. Will gold's role as a safe haven asset continue to strengthen amid these challenges, or will shifting market dynamics create new investment opportunities? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.